Hi everyone, please take note of the following disclaimer. Please note that this video is for informational, educational, and entertainment purposes. It does not constitute financial advice. We are not registered financial advisors. Hey everyone, welcome back to the channel, your number one source for income-oriented investing, where we don't ignore total returns. And about 10 days ago, at the time I'm filming this anyway, I released a post, a members only post in the community saying that it's been a while since we've done a live stream where I take all your questions in and answer them live, right? And I said, you know what, in the next podcast, in the next PII Uncensored podcast that I do with Erica, we'll answer all their questions. We'll make it an AMA. And after looking at the more than 50 questions, I realized that 99.9% of them, almost all of them, are really technical questions, have nothing to do with Panama. There's no personal questions. I thought there would be like more personal questions, but there isn't. They were all technical, investing related questions. So I figure instead of doing that on the podcast with Erica, which makes no sense because they're all technical questions, which I'm going to be answering anyway, I'll do a full video for that where I will answer all these questions. So hopefully the point of this is to be educational and to really try to answer all the member questions. And I'm showing this video to everyone. This is going to be a public video, but going forward, if you like this format of video, if you like this content, I realized that, I used to answer the questions on a live stream, but I realized that it's much better to do it in a regular video because I could share my screen, I could educate, I could edit, less stress of a live stream. So I'm going to be doing that going forward. So if you like this type of video, the next ones are going to be for members only. So you're going to have to be a PII Inner Circle member. So hit that little join button, make sure you're a member, and you'll be able to ask your question and I'll answer the question in a video. So let's go through all the questions, guys. There's a lot of questions. So let's get to it here. And you could follow along. If you're a member, of course, you could follow along, but I'm going to be showing you the questions here. So a total of 59 comments here, 59 questions, but there's about 50 in all. So let's go through them all, guys. We'll go through every single one of them. And just for the record, by the way, sometimes, I might seem a little bit snippy when I answer some of these questions. Don't take offense to it. You guys need to remember that I've been doing this for years and years and years. Well, years and years, a long time now. And I do get a lot of the same questions over and over and over and over. So it's absolutely, don't take offense if I'm a little bit snippy. You guys need to understand that you, the PII Inner Circle members, I have the most love and loyalty for. I will always be loyal to you and I will always give you top priority and always bend over backwards for you guys. I really, really appreciate the couple of dollars that you spare to be every month, to be an Inner Circle member, even though it's only $3 Canadian. Really appreciate it, guys. So here we go. The goal is really to educate and to answer your questions as best I can, okay? But some of these questions, you're going to have to kind of do your own research as well, but I'm going to give you a good starting point. So first question with a lot of likes here. Difference you see between HHIS and BIGY. So I do have a video, HHIS versus BIGY plan, but I'm going to give you the main differences that I see right away. First of all, HHIS is a little bit more wider. It has 20 stocks, right? You have the stocks here. And BIGY is now 11 stocks. So they recently added Eli Lilly in the mix. So that's the first thing. It's the stocks, right? But keep in mind that all 11 stocks in all 11 stocks in BIGY are in HHIS. So HHIS is, I really feel it's kind of a concentrated NASDAQ, if you will. BIGY even more concentrated. So the stocks is number one, even though there's a pretty much 100% overlap, HHIS has more stocks, right? Second difference is the leverage. HHIS is 25% leverage, BIGY is 33% leverage. That's difference number two. Difference number three is BIGY is hedged to the Canadian dollar, right? HHIS is not hedged to the Canadian dollar. What does that mean? They're both denominated in Canadian dollars and they all invest in US stocks. That means if the Canadian dollar gets stronger versus the US dollar, that helps BIGY and hurts HHIS a little bit, but the opposite is also true. If the US dollar gets stronger and the Canadian gets weaker, that's going to hurt BIGY and it's gonna help HHIS. But the currency is really, it's kind of like HYLD, right? HYLD is hedged to Canadian dollar, USCL is not. So currency does make a little difference, but like HYLD has shown me over time, it's not a massive difference. but it is a difference between BIGY and HHIS. Maybe BIGY will come out with an unhedged version. We'll see. That's another difference. The management fee is the same. The leverage we talked about. A big difference is the cover call strategy. So BIGY is really kind of a rinse and repeat strategy. It's at the money calls on 50% of the portfolio, guys. That's part of their ultra yield series, right? So it's a very straightforward, you know exactly what the cover call strategy is. Pretty much they're doing cover calls on half the portfolio, but you're giving up upside on that half because they're doing at the money calls. This is why the yield is higher on BIGY, right? It's higher on BIGY because they're doing a little bit more cover calls and there's a little bit more leverage. HHIS, you guys know the harvest. And in case you didn't watch it, you know, there's a video, of course, where we talk about HHIS in detail, guys. I highly recommend you absolutely need to watch that video if you haven't seen it, with this one right here, right, where we talk about MSTE, but we also talk about HHIS in detail. If you own HHIS, you need to watch this video. We talk about it in here full. But HHIS, they're not going to do as much cover calls. The harvest method is, yes, they could go up to 50% covered calls, but they're typically near the 33 to 45% range, more near the 33% range. So a little bit less covered calls with HHIS, more upside or less upside cap. But you have more leverage on BIGY, right? I did a Q&A with Raj when it comes to BIGY as well. So you might want to check out that video as well. By the way, very easy. You go on the homepage of my channel, right? You click on the name of my channel and you could actually use the search here, right? You could use the search. If you search BIGY, you'll probably get it. It's right here, right? So in this video, I believe I talked to, no, this is not it. Here's the Q&A. So the Q&A, there's a Q&A with Raj. You could check it out, right? So, but BIGY is pretty straightforward, guys. Those are the main differences. Now, I think the most important difference in what I've seen is that BIGY seems to rebalance, right? I've seen a rebalancing. So now what I mean by rebalancing, well, now that there's 11 stocks, it's not 10%, but I've seen strategy go down and Coinbase go down, and then a few weeks later I saw them back at 10%. So it seems like, maybe I could be wrong about this, but it looks like Evolve is going to rebalance a little bit more aggressively, where HHIS, it seems, and again, we talk about it with Paul McDonald and about the strategy of the rebalancing. I asked him about that. Maybe a little bit less rebalancing, right? So you could see, you know, the stocks that are doing well take up the bigger positions, and the stocks that are not doing well really go down in terms of percentage. Now, I'm sure they're going to rebalance a little bit over time, but it seems like HHIS, in my opinion, a little bit more actively managed versus BIGY's a little bit more systematically managed. So you really again, guys, you really need to understand the stocks, like the stocks, which very, very similar, right? All 11 are in HHIS. Cover call strategy we talked about, the leverage we talked about, the fees about the same, the rebalancing, and then the hedging. Those are the main differences between them. So hopefully that answers your question. As a Canadian that will max out TFSA and RRSP and would go into a cash account, not really a choice, what funds would be best tax friendly and still have a good total return on them? So I get this question over and over and over and over, right? What are the most tax efficient things in a cash account? If you understand how taxes work, you're never going to have this question. The answer is it depends. It depends on your tax bracket and it depends on your province. Okay, that's really what it is. And as usual, guys, I have a whole playlist. Okay, if you go to my playlist, I have a whole playlist dedicated to taxes, investing taxes for Canadians explained. Okay, you can look at the full playlist. This is all about taxes. And one of the videos that has a lot of views, I guess I'm going to have to make another one that I came out with 3 years ago, how to maximize tax efficiency in a Canadian cash account. So this is really all about understanding, right? Understanding. I have other ones as well. 10 months ago, how were covered call ETFs taxed? Watch these. You got to understand. And it really depends on your province and tax bracket. Okay, that's really the answer. You're going to have to do a little bit more research on your own. Good total return on them. Well, the total return has nothing to do really with the taxes, right? It has to do with the total return. Randall, my friend, 2 years and 8 months. So you've been a long time watcher, of course. Do you miss the snow? No. Okay, the real question. Okay, here we go. It seems that your portfolio is very concentrated on tech. It is. QQCL, which is about half tech, 50% tech, right? It's a NASDAQ 100, but it has other stuff like Walmart, Pepsi, Costco. QDay, yeah, that's, I would say, 100% tech. It does have a NASDAQ 100, but they're doing the at-the-money calls every day on those. So you pretty much, and QDay, you notice now, it's not XLK anymore, it's QMVP. So it's actually a little bit more wider, more diversified within the tech space. HHIS, very heavy on the tech, but not full tech, right? Costco's there, Eli Lilly's there, and other things as well. But it is mostly tech, right? It is mostly the Mag 7. And BIGY, which is basically the Mag 7 Palantir strategy. And Coinbase, and now Lilly. Together, they are close to 60% of the portfolio in size. Even HYLD, by the way, is majority tech because it's the S&P. Do you think this level of concentration in one sector is too risky? So, Randall, this is what I will tell you. Risk is in the eye of the beholder. Okay, risk is in the eye of the beholder. What I think is low risk could be high risk for someone, right? Bonds are classified low risk. I consider them high risk at getting screwed. You see, what some people consider Bitcoin really, really high risk. You talk to a Bitcoiner, they think it's the lowest risk thing out there. Risk is in the eye of the beholder. Volatility is the price movement. So volatility is not risk. Risk is not volatility. So volatility is just how much things move, right, in terms of price. So this is a subjective thing, Randall. Personally, I'm very, very comfortable with my portfolio. Else I wouldn't have this portfolio, right? You need to remember that if you're going to be a long-term buy and hold investor like me, buy and hold because of the covered call strategy, because we're getting distributions every month, which is kind of like an auto drawdown system. I have PIIers, not just me, PIIers. We have the privilege of staying in the market forever, right? And you've all heard the expression, the best defense is a good offense. So I'm okay with higher volatility sectors because I don't care about volatility. I'm not a trader. I'm not getting out in a year or 2 years and 3 years. I'm in it for the long term. And tech stocks are the future. We're going to need more tech. They've been the best performing assets, the best performing stocks. I see that continuing. Of course, now there's all kinds of nonsense. AI bubble and blah, blah, blah. Guys, I don't care about the next 6 months. I don't care about 2026. I don't care about 2027. I care about the next 10 years, okay, 10, 15, 20 years. And I still believe that technology stocks will continue to outperform. It will be the hottest and best sector long term. I have a tech bias, of course, because I worked in the tech sector. My wife did as well. I believe in technology. I think it's the most important thing ever. Of course, now they're talking about how materials are important, things like that. Well, you see what I mean? That it's risk is in the eye of the beholder. So personally, I don't think this level of concentration is too risky, but that's just me. That's just me, my friend. Maybe you do, but remember, you got to think like a long-term investor. If you're going to buy and hold forever, think about this, guys. If you're going to buy and hold forever, why would you hold more defensive stuff that you know is gonna underperform over the long term? Maybe it'll be less volatile. Maybe it'll outperform the riskier tech stocks in a certain month, in a certain year. But I don't care about a certain month or a certain year. I only care about the next 10 years. I care about the long-term trend. And I believe tech is the way to go. That's just me. But yeah, exactly. That's just me. And another thing you need to remember, I'm an income investor, right? Cover call premium income investor. So this is what has the most premiums as well. Okay. Sorry about that. Okay. One more question before I got to take my break to do the one-on-one coaching session. And then I'll be back. Why is HHIS? This got a lot of likes, guys. This has me worried. Why is HHIS not performing well even though the NASDAQ is doing better? Ooh, 9 months. I don't know what you're talking about here. If I do a total what exactly are you looking at that you're saying HHIS is not performing well? Are you looking at 1 day? Are you looking at 1 week? Are you looking at 1 month? Are you looking at now that we have the 1 year data? If you do HHIS versus the NASDAQ 100 versus the S&P 500, HHIS is outperforming by a lot. You could see the percentages, right? Of course, this is ending on December 31st of 2025. We're going to get the data as time goes on. Of course, HHIS, all tech stocks especially, have had a rough time in January and right now. But again, guys, I don't care about the short term. I care about the long term. And to me, this just shows how HHIS is doing exactly what I expected to do. During an up market, right here, it's outperforming the S&P and the NASDAQ. I look at HHIS as a concentrated NASDAQ. So if the NASDAQ is doing really, really well, I expect it to outperform. And it is. If you look at the upward trend, HHIS is on the upward trend, just like the NASDAQ is beating the S&P. It's just normal. But when things start going down, I do expect HHIS to underperform the NASDAQ and the S&P on the way down. It's completely normal. And you actually see that here. We have a little hint of it here, right? If you look during a downtrend, HHIS is down the most. This is 100% normal. HHIS should be down more than the NASDAQ, and then more than the S&P. And you see the NASDAQ is down a little bit more than the NASDAQ. The NASDAQ is down a little bit more than the S&P. This is normal. This is how things should be, right? Because you have more concentration in tech, more volatile, more risky. But on the uptrend, what's going to outperform? The NASDAQ is going to outperform the S&P long term. And I expect HHIS to outperform. So right now, I wish we had until January 31st. But of course, maybe HHIS is going to start underperforming. Now it's completely normal because the tech stocks are not doing well. But again, I don't care about 1 month or 6 months or, I want to see the trend. What is the long-term trend? So this comment worries me because I don't know what the heck you're looking at, but start looking at total returns. Okay, start using these tools and look at the total returns. HHIS is doing fantastic. Okay, take a break. All right, everyone, moving on. In a recent video, you discussed a portfolio you would have if you were still a Canadian resident. I was surprised it was not the same as your current 4 Horsemen and did not understand why it would be different. Well, are you sure you watched the video? Because I think in that video, I pretty much said my main portfolio, TFSA and cash account wouldn't change that much, right? So I'm not sure exactly why you're saying this. The only thing I said that would probably be different is that I would have kept my RRSP, and in the RRSP, because there's no 15% withholding tax, I would look at some US listed funds that I liked, including the leveraged NEOS and leveraged TAP Alpha ones would be of great interest to me. So my portfolio really wouldn't change that much, to be honest, on the Canadian side. So I'm not sure exactly why. And by the way, in case you're wondering what video we are talking about, this one here. So videos, make sure to check it out right here. My income portfolio and investing strategy if I was still a Canadian resident. So maybe you should rewatch that video because it's pretty clear there that I would pretty much stick with the same stuff in the TFSA and the non-registered account, which is my main portfolio, or the bulk of it anyway. 12 likes on this one. Hi, Adrian. These 2 days, S&P and NASDAQ all perform way better than HYLD QQCL. Is this because of the exchange rate? So first big thing with this problem with this question is, why are you looking at 2 days? Makes no sense. Second thing is that just because it's in Canadian dollars, it doesn't matter that the fund like QQCL and HYLD are listed in Canada and in Canadian dollars. If the exchange rate is going to be a factor, it depends if it's Canadian hedge or non-hedge. So HYLD is hedged to the Canadian dollar. QQCL is not hedged to the Canadian dollar, which means if the US dollar gets stronger that day and the Canadian dollar gets weaker, that helps QQCL. And it hurts a little bit HYLD, but of course the opposite is true. I just talked about this earlier, right? So guys, when you're looking at returns, please don't look at stock prices. Please don't look at 1 day or 2 day. QQCL, we have more than a year of data. HYLD, we have plenty of data, right? Always look at the total returns. HYLD, always do it versus VSP, right? It's a very nice comparison. You're talking about the S&P 500. So HYLD is Canadian hedged. You have to do it versus, to get a proper idea, an S&P 500 that's hedge the Canadian currency, which is VSP. VFV is not hedged. So a USCL you would compare to VFV, and a HYLD you would compare to VSP. So if we do HYLD versus VSP starting in February 1st, 2024, because that's when HYLD made its transformation and is really the HYLD, or actually even got better than that point, but it's really when HYLD got fully internalized. So whenever I do an HYLD comparison, guys, always start in early 2024. Forget about 2 days, guys. 2 days doesn't matter. You got to look at the long-term trend, and the long-term trend tells us that HYLD is doing just fine versus the S&P 500. It's even outperforming it here, okay? And if we do QQCL versus, let's take January. QQCL, very easy. NASDAQ 100, that's not hedged, which is QQC, hence QQCL, right? QQCC. I always do that. QQC. I always do that. So as you could see here, if we do QQCL versus QQC, QQCL is doing completely fine. It's outperforming, right? If the markets, if you're doing a performance analysis where the markets are doing fairly well, the leverage one is going to do either maybe slightly better, or if not, very similar, right? But if you do it during a downtrend, the leverage hurts a little bit. So you forget about 2 days, guys. The answer to the question is, where was I? Sorry about that, guys. My cat's yelling like a maniac. So yeah, do the total return comparisons, guys. Not 2 days. Okay, forget about 2 days. Things could be weird in a day. You just never know. And when it comes to the currency conversion, always do the appropriate one. So QQCL versus QQC, HYLD versus VSP. So as you can see, QQCL doing just fine. Okay. This one, if we go to a little bit earlier, so if we just take 2023, we go since inception of QQCL, it's pretty much, wow, it's still beating it. It's my expectation is that QQCL is going to do more or less what the NASDAQ 100 does. Okay, there you have the proof right there. Look how tight those graphs are. Okay, that's the expectation. But of course, in the short term, 1 day, 1 week, it might not correlate perfectly, but that doesn't matter. You got to look at the correlation long term. Okay. Next question. Why do you hold HHIS and BIGY? Good question. I've been getting a lot of HHIS versus BIGY questions, and I already did a comparison. I'm going to have a video coming out on that. But essentially, it's because I like both of them, guys. That's really the question. So they overlap pretty much 100%. BIGY is hedged the Canadian dollar. HHIS is not. BIGY has a little bit more leverage, a little bit more covered calls. HHIS has less leverage, a little bit less covered calls, a little bit more stocks. I like both of them. Maybe one day I'll swap BIGY into HHIS. I don't know. But the short answer is I like both of them. Okay, short answer, but that's really, really what it is. It's, oh, and by the way, BIGY pays twice a month and HHIS pays once a month, but I don't really care about that personally. If we step away from total returns, which current ETF is the most defensive if we do have a secular downturn? I believe this to be STRC. Well, STRC is full of US dividend stocks. So dividend stocks in general, guys, are considered a little bit more defensive. So STRC for US dividend stocks, CDAY for Canadian dividend stocks. But, don't forget there's still leverage in there. Can we discuss ETFs Adrian would have bought today if we were in 2007 December, if all those ETFs were available then? That's an interesting question. So first of all, let me just talk about, I get this a lot kind of question when there's volatility in the market. What's more defensive? What's more defensive? What has less risk? Guys, risk is in the eye of the beholder. I repeat, risk is in the eye of the beholder. So to me, the most solid defense you could ever have in your life is putting in your mind that to never sell anything. To me, there's no better defense than never selling anything, right? If I have HHIS or QQCL or HYLD or whatever, the four horsemen, right? I never have to sell them. To me, whether there's a 40% crash, a 50% crash, doesn't mean anything, doesn't matter. My defense is that I don't have to sell. I don't understand how this is such a hard concept for people to understand. So if you're talking about more, excuse you, Bachi, my cat's acting out here. That is the most defense. Okay, if you ask me, it's the ability never to sell anything. This is why I'm a long-term covered call income investor. So I don't need defense. I don't need to do a rotation. I don't need to go risk on, risk off, all that crap you hear in the news. Why? I could be risk on my whole life. Isn't that amazing? That's a privilege, guys. It's a privilege. Now, if you're asking me which ETFs that I really like are a little bit more defensive because they have more defensive stuff in it, because they're more diversified geographically, et cetera, watch the four defensemen of PII, those four particular funds. But you would be right, where an SDAY and a CDAY and more, dividend oriented funds would do that for you as well. But to me, there's not much, why go in a SDAY when you have HYLD and HDIV, with SDAYs in it and CDAYs and HDIV. So to me, this whole rotation, defense, protect yourself, hedge yourself against the market downturn is all nonsense, because I don't have to do that as a long-term buy and hold investor. That's just so the people on the news have a lot of stuff to talk about, guys. That's all it is. It's a scam. It's nonsense. So if you want less volatility, then which I don't really understand why you would do that if you're buying and hold forever, but some people just don't have the stomach. I respect that. You got to make your own investing decisions, and that's fine. I would consider maybe the four, or a combination of the four defensemen, because they have a little bit more defensive qualities in my opinion, but they're still diversified. They're still really good. They pay, they have a little bit of leverage. They pay monthly. But again, risk is in the eye of the beholder, right? So you got to remember that. And can we discuss ETFs Adrian would have bought today if we were in a 2007 December? If all those ETFs available today were available, then I would buy the same ETFs, guys. If I knew that tomorrow, Monday, if I knew that the market was going to crash 40%, I would buy the same thing. I don't care. I don't care, because I'm not selling anything. So why would I care? I want, my opinion, this is what I want. The stuff that's going to have the most total return over time, right? And this is why I'm okay going more tech heavy and going into HHIS as my biggest position, because I'm in it for the long term. I don't care what HHIS does this year in 2026, guys, or during a crash. Is it going to go down more than the NASDAQ 100? Yes, and the NASDAQ 100 is going to go down more than the S&P 500, and the S&P 500 is going to go down more than an SCHD, which is more blue chip dividend stocks. But if you look at the total returns, it's the opposite. The more riskier you go, typically, the higher total returns you have over time. I'm not talking about 6 months. I'm not talking about 1 week. I'm talking about 10 years plus. So for me, I don't care about this stuff, right? I don't need to rotate, right? So hopefully that makes sense. So yeah, pretty much I wouldn't change a thing. Next question, if you were someone who doesn't need the income to live off of right away, would you go more risky to snowball the portfolio quicker? For example, MST is down substantially. Should I focus on building out that position now while it's cheap and then build off of that? Guys, anytime you're dealing with, I'm going to say this again, when it comes to one stock, if you're going to invest in one company, you have to have that long-term conviction and know what that company is doing. So, and this person says, I know it's a risky position, but here's again, risk in the eye of the beholder, right? If you talk to 5 different investors, ask them what's the risk of Bitcoin or MSTR. One of them might say Bitcoin is 0 risk for me. I'm a Bitcoin maximalist. For me, it's 0 risk. One might say it's the riskiest thing in the world. That's crazy. One of them might say, you know what I mean? Risk is in the eye of the beholder. What's important is this line, my friend. Brian H. This is the line that's the most important. But I have conviction in Bitcoin and MSTR. That's what counts. Now, how much conviction do you have? 5% allocation, a 10% allocation. My MSTR conviction, what is it? 10% allocation approximately. In Bitcoin as a whole, 25%. Someone who has more conviction, maybe it would be 15% MSTR and 30% Bitcoin overall. Someone who has less conviction, maybe it's 2% MSTR or MSTE and 10% Bitcoin overall. Someone who has no conviction in Bitcoin and maybe they're just curious, it would be 1% or 0.5% just for fun, right? So it really depends on your conviction. You got to have a conviction if you're going to invest in a single stock. If you don't, you go for the diversified stuff, okay? Next question. Why your parents delay conversion to the RIF as long as possible and then only take out the minimum? Are they not setting themselves up for a very large tax bracket late in life or for their estate versus strategically converting earlier and drawing down more the minimum amounts now to smooth out the tax brackets? Look, there's many ways of doing this. There's many opinions. I know a very common one is to draw down your RIF as soon as possible. I believe the most in the stock market, staying in the stock market the longest possible to get those compounding tax sheltered returns in the RRSPs or RIFs, the RIFs and LIFs. Don't forget, guys, if you're taking out the minimum, my dad's RIF, 75%, we're taking the minimum and we're even using my mom's birthday, so it's even less, right? My dad's like 75, 74, and my mom's 68. So we converted so it uses her birthday because I want my parents to stay in the stock market as long as possible because you get bigger and bigger returns. My dad is able, by taking the minimum, to reinvest about 75% of his distributions, right? And he's in the 4 Horsemen. So I believe that the longer you stay in, yes, they'll pay more tax, but the money will grow a lot more. I'd rather do that, and I'd rather keep it simple. So that's really the short answer. Would it be better tax-wise to draw it down? Maybe, but this is the strategy that we're going with. And, you know, my parents, myself, and my 2 sisters are fine. Whatever the tax is, we'll pay the tax. Okay, we'll be fine. We're not worried about that. How do you plan to handle your family's registered accounts for taxes? Okay, I'm guessing non-registered accounts for taxes. Do you plan to melt them down the same as the reg account into the TFSA? So Kyle, my friend, I laid it all out in this video. So I'm not going to go through it because it's 20 minutes. My parents finally sold their house, their retirement blueprint. The whole plan and blueprint is in that video. So make sure to check it out. Okay. Next question. Is it a good idea to keep both BIGY and HHIS in a portfolio? Only you could answer that question, not me. Okay, it's a matter of personal decision. It's not that it's good or bad. There is no good or bad when it comes to investing. You're going to have to make that decision. Understand what BIGY is, what HHIS is, the differences, and you got to make that decision. Why do you like ECHI over the other Canadian focused funds? So when I was thinking about adding a Canadian focused, when I was thinking about adding Canadian focused position to complement my Class A ETF and HDIV ETF and the TFSA, I was basically looking at either CDAY, ECHI, HHIC, or CANY, right? Those are the 4, in my opinion, 4 competitors, which I can't wait to compare once they all have a year of data. CDAY, I figured it's in HDIV, so I let it go. CANY, I think doing too much covered calls on Canadian stocks is generally not a good idea. And if you actually look at the total returns right now between ECHI, let's do it. So you guys could see my screen here, right? Okay, so if you do HHIC, so it was really between HHIC, ECHI, and CANY. If you do HHIC versus CANY, they have some similar stocks, but CANY is really more focused on the financials. So because I have a lot of financials already with Class A, that's one consideration. But if you do HHIC versus CANY, you see the big underperformance CANY is having. That's because I think they do too much covered calls. That's my opinion. The stock selection also. Right, on the American stock market, options are much more liquid, so maybe BIGY makes more sense. But we'll see in a year. This is not a year yet. This is preliminary data. I always like waiting a year to do it. But so far, CANY is getting destroyed by HHIC. So then it's HHIC versus ECHI. And because in the TFSA, guys, my priority is really 100% total return, because I'm always planning to reinvest everything in the TFSA, within the TFSA. I just said I'm going to take the one that has the highest total return. And right now it's ECHI. I'm making a promise to you guys right now. If HHIC starts outperforming ECHI in a few months, in a year, next year, for a while, I'll swap them out. I just want the one that has the highest total return, guys. That's it. If you were still living in Canada, what would be your holdings? Did a video on that, just talked about it. My income portfolio, if I was still a Canadian resident, make sure to check out that video. And if they would be different than their current pillars. So another question related to that. Watch that video, guys. I made that video specifically for this. What tool I can use to check my mainly Canadian listed ETFs for overlap? HYLD, USCL. Go on the websites, dig into it, and it's very easy to figure it out. Okay. I don't know if there's any tools for that, but it's really looking at the stocks inside. So USCL, very simple. It's the S&P 500. HYLD is a concentrated version of the S&P 500, right? So the best thing that I do, the thing I do the most, I get my information from the fund manager's websites. I don't trust any third-party tools for that kind of information, right? This is why even total returns, I use the BMO website, I use the compound calculator, and I look at the fund manager's website, right? Hey, Adrian, what ETFs would you consider to be the 4 horsemen of U.S. income funds? That's a good question. 5 likes. I think in the US, if you're American, the best income-oriented funds are either a combination, or either one or the other, S&P 500 or NASDAQ 100 covered call ETFs. Okay, that's really all you need in the US. Who do I think are the best providers? It would be Goldman Sachs for GPICs and GPIC for your basic options. NEOS for another more classic strategy basic option with a little bit more yield. And then there's Tap Alpha as well. So those are the 3 providers I think are really, really good. What I'm most excited about now are the leveraged versions of SPYI and QQQI from NEOS, and the leveraged versions of T-SPY and TDAC from Tap Alpha. They recently just came out. Those would be the ones probably the 4 horsemen, probably over time would be those 4 leveraged ones. But that's now. A year from now, who knows what could come out. Which company and which ETFs is most likely to start weekly payouts? I think BIGY might be. So everyone wants to do Hamilton and Evolve and Harvest. They all want to do weekly. They can't do it. There is no plumbing in place in Canada yet to do that. So I don't know who's going to do it first, but it has nothing to do with Harvest. It has nothing to do with Hamilton or Evolve or anybody. It has to do with the plumbing, with the exchange, CBOE or the Canadian stock market regulator crap. So as soon as they allow it, and maybe you could send them an email. I don't know who you would send an email to. Regulators. I mean, who like they even read them anyway, these people. But I think they'll probably all, I don't know if they'll change them for their existing funds, but I know Evolve already put that in the prospectus that it could be weekly or more. So maybe some of them will do it, maybe some of them won't. They'll have to change the prospectus, but they're all interested in doing it. It's really because of the plumbing is not there yet in Canada. Next question, will you be looking into Stretch once it's listed on the TSX? That's a good question. The answer is no, because although it might be very, very interesting, and I'll definitely make a video on it, I think I'm going to have to make a video on Stretch, because it could be one of the really good ways that if people want stability and they're okay with Bitcoin, they want the lowest volatility, lowest risk, Stretch is amazing because it typically trades. The goal of Stretch, okay, if you're Canadian, you'll understand this. Stretch, to me, the easiest way to understand it, it's a preferred share of a split fund. Okay, that's the whole goal of Stretch. It's to be the preferred share of a split fund, the Class A share being MSTR. So in a split share fund, the preferred share gets a coupon, typically 5% yield, does not capture any of the ups and downs of the portfolio. Of course, people could still buy and sell it. So the stock price is typically always around $10, right? For a preferred share. Doesn't mean it's always going to be $10. It could be $9.90, $9.80. It could go to $9, $9.50 if there's a big market sell-off. If there's euphoria in the market, it'll go to $10, $10.50, even though it's worth $10, right? So it's always near that $10 range. You have a lot of stability, but you're trading, you're getting that stability, but you're doing a trade-off. You're trading capital gains. You're trading return. You're getting 5% dividend yield, and that's about it. Stretch is the same thing, but in a Bitcoin lens, right? But it's 11% yield. And it's all return of capital dividends. So if there would be a Canadian, of course, you could put it in your RRSP if you're looking for an 11%, something that's 11% and relatively stable, right? It's still relatively new. So, when there was a big Bitcoin crash, it went from like 99 to like 94, 93. But one day later, that big rebound, it's back to 98, 76. So this is Strategy's flagship product. I really think, it's very, very popular. Over time, I think it's going to get more and more stable. So you're looking at a fairly stable stock price with an 11% yield paid out monthly. It reminds me a lot of a preferred share of a split fund. So for your question, if it's going to be listed on the TSX, I wouldn't be interested because I would never buy a preferred share of a split fund. I would always buy the Class A share because I'm buying and holding it forever. I don't care about 11% yield. I'd rather get the MSTE. Of course, I would rather get the MST, right? You'll get a lot more crazy volatility and could go down, it could be crazy, but I'm a long-term investor. But if it is listed in the TSX, someone who's older, who's a retiree, who wants consistent income and take lower risk, it could be an extremely amazing proposition to look at for sure. Right? But like maybe my parents, but even my parents, I still wouldn't put them in that. I would rather put them in a NASDAQ or an HYLD. But if you're getting a consistent 11% yield and the stock price is relatively the same, we're talking almost S&P 500 average returns here. So it could be very interesting. What is the hiking this is actually one of the only Panama questions I got. What is the hiking or walking off the beaten path like in Panama? It really depends where you are. If you're in the city, it's a city. If you're in Coronado and you go even more west, it's more country, right? Have you ever gone and how often? Not really. We haven't explored that much, to be honest. We're just so freaking busy. Are there any safety concerns such as certain animals, bugs, or snakes? Not so bad, not crazy, but I've seen like little scorpions. I've seen little grass snakes, but it's a beautiful country. If you're into walking and hiking and exploring, Panama is an incredible country. I want to reduce my stake in HHIS because I feel tech may continue to not perform as well as last year, and I think the industry wants to see AI development, not spending only, but not sure. So this is where you're going to fall into the classic trap of looking at the news and the headlines, and these people are stupid. They don't know what the hell they're talking about, and stop thinking long term. You have to think 5 to 10 years out as an investor. And I believe HHIS will continue to probably outperform the NASDAQ 100 over the long term because it's more concentrated. So if you feel it's not about, you have to define risk in a better way. Look at it more as volatility. If you can't stomach the volatility, then I understand. But you got to look at things long term, and you got to ignore the retards on TV, guys. It's just short term crap that they talk about, rotation and AI bubble. It's just trend. It's just trends, and trends are the worst things in investing. So I remind you to look at my recent video, fake investing versus real investing, because there's a big difference. But you still have to be comfortable with what's inside HHIS. I look at it as a concentrated NASDAQ. You still have the Mag 7, right? You have Costco, you have Netflix, but then you have more fancy stuff like Strategy and Coinbase and SoFi and Reddit and stuff. So you need to be confident in that group of stocks, but it is still diversified. But forget about the news, okay? I don't pay attention to that at all. In fact, when I see that kind of fear and I see AI stocks selling off, I get excited because it's a buying opportunity. If you're a trader or a swing trader, man, I don't know how those people sleep at night. It's a completely different story. As an investor, it's a completely different story. Hi, Adrian. If you were still in Canada, would you still hold RS like you did before you left? It's a good question. I don't know. My guess is probably not, just because I just hate real estate. I just hate everything about real estate. It's dirty. I hate buildings, and it's just a mess. It's such a crappy, overrated business. It hasn't been performing well, especially in Canadian real estate. I don't really believe in it. I think it was super overheated and now it's going to die down. My theory is, if you're not going to beat the S&P 500, what's the point of holding a particular sector like real estate or utilities or healthcare? To me, it's not worth it. This is why I most of my, if not all my funds are diversified and are tied to the S&P and especially the NASDAQ. The only other sector I have is really Bitcoin, because I feel over the long term, it's going to outperform the US market. Am I going to be right? Am I going to be wrong? I don't know. But again, I'm not thinking about 3 months, 6 months anymore, guys. I'm thinking about 10 years plus. So I probably wouldn't hold RS. I would probably swap it out, I think. But hey, RS never missed the dividend payment, right? It's still, in terms of the real estate, I think it's, it still has quality stocks as well. You hold RS if you believe in the Canadian REITs, guys. That's pretty much it. It's a collection of Canadian REITs with a split share function, which means it's going to be leveraged, right? I have a question related to health. I am an older age than you two and would like to know if it's easy to get medical insurance in Panama and how expensive it is. It is easy to get. A lot of people have it here. I'm not sure if you want to discuss this on the podcast. Well, you could get it, but it's, a lot of Canadians are really scared about leaving the country because, they think they have free and good healthcare in Canada. Meanwhile, it really sucks in Canada. But in terms of healthcare, Panama is actually one of the best countries in Central America. And you could get insurance. How expensive it is, I don't know, but I don't think it's that expensive. Depends what kind of insurance you get too, right? Still happy living in Panama, far away from the cold weather in Montreal. Absolutely. Absolutely. Sorry, guys. Is it too small for you? How did you open a bank account in Panama before becoming a resident? So you do everything via the lawyer. It's very easy to open a bank account. It's just tedious, especially if you don't know Spanish. If you know Spanish, you're going to get along real well. But the first thing we did is go to a lawyer. I have Panama videos. You could check them out. You go to the lawyer will send an email to a bank contact, and you go there, you show up with all your documentation. The first thing you really have to do to establish roots in Panama is to open a bank account. That's like the first thing. So it's pretty easy, but it's just tedious. But the lawyer helps you with all this stuff. How do you send money from your Canadian bank account to your Panama bank account? International wire transfer. Not complicated. I liked your video about Panama. Thanks. Okay. What do you think about the Harvest new fund, HPYB and HPYE, up to 50% leverage calls and puts? I think it's very, very interesting. I love how they're trying to innovate in the space. I don't know how it's going to work out. Ask me in a year so we check the total returns, right? HPYB, obviously I'm going to compare it to bank and 6C and ZWB and ZEB and HMAX, and then HPYE, I would probably compare that to something like an SDAY or an HYLD, something more diversified US focus. So we'll see what happens, right? What do you think of HPYE and its strategy? Well, same question. For a Canadian resident, which funds would you recommend for a new TFSA portfolio for short-term investment, 6 months to a year? Short-term, 6 months to a year, probably something like an SPLT, a collection of the preferred shares of the split fund, something like an SPLT or pref from Quadravest, where you'll get 5-6% yield, very, very little volatility. Anyway, disclose what percentage is the tax rate you have living in Panama. It's zero. There's zero tax in Panama. There's zero tax on foreign income in Panama. All my income is foreign to Panama, so I pay zero. As a Canadian non-resident, do all brokers refund the 25% tax on capital gains and return of capital, or just Questrade? Well, Questrade is the only Canadian broker that you could actually stay with if you become a non-resident, as far as I know. Then there's IBKR, of course, but it's not a Canadian broker. But yeah, they should all do it automatically, the ones that accept you or, you know, want to keep you as a non-resident. Why is SPLT down? So SPLT is the ETF I just mentioned, where it has a lot less volatility. But again, guys, just because they're preferred shares and they don't participate, people could still buy and sell them. So even during a market sell-off, you'll see the preferred shares of a split fund go down 5 and 10%. It's very rare if it's violent. So, I mean, what is SPLT? I haven't checked it in so long. Yeah, so if you call going from 1010 to 1132 to 1079 down, man, you really have zero stomach, my friend. So the short answer is it's down because the preferred shares can still trade. Some people, and if more people are selling them than buying them, for a particular reason, if there's a sell-off for a particular reason, they will go down. But it's the net asset value that you need to look at, the NAV versus the stock price, right? They could move. It's not a GIC. If you had to amass your PIA portfolio again, and we're just starting off while working a job, what kind of fund would you choose to buy, drip, compound? Base it on sector, index, region, yield, all in one fund of funds? It would be based on total returns. That's what it would be based on. It would be income oriented, but it would be what I feel will have the best total return over time, which is a combination of pretty much what I have now. What's your thought on BLOX? Is it something you could answer Q&A separate video? Yeah, I think BLOX is kind of like the American version of HBTE. So BLOX is a collection of crypto related. So if you're crypto curious, something like BLOX, and you're an income investor, something like BLOX makes sense because it's, you're not investing directly in Bitcoin or Ethereum or in crypto, but you're getting kind of like crypto industry. So you'll have things like Bitcoin and Ethereum, and Bitcoin miners, but you'll have things like IREN, like data center, AI data center, NVIDIA, right? Coinbase. So it's kind of like a little diversification within the crypto sphere. So I think it's good. In the US, it's the best one, I believe. There's a couple of them. In Canada, we only have basically HBTE from Harvest, which I own. So I kind of like this concept. It's part of my core. HBT is part of my core Bitcoin exposure holdings, if you will, part of that 25%. Is HHIS total returns underperforming the underlying? It sure feels like it. Your feelings don't matter. I don't understand why you should feel anything when you're talking about total returns. Just look at the total returns, right? So listen, HHIS is a combination of these stocks, and you're getting that exposure via so Alphabet via individual ETFs that hold a single stock. So this one holds Google with 25% leverage and covered calls. And we know that when you do covered calls, like Harvest does it, 33% to 45 to 40% approximately, plus you add 25% leverage, we all know now that you're going to get similar performance, similar performance over time to just holding the Google, to just holding the NVIDIA, to just holding the Broadcom. So could it be a different? Could be maybe sometimes higher, maybe sometimes lower. It depends. But like I showed before, guys, HHIS is doing completely fine. I don't understand where this underperformance is feeling. Of course, if tech stocks sell off like they've been doing, and HHIS is more concentrated in tech stocks, it's gonna underperform. But that's within that time frame. You got to always think long term. And of course, the more months and the more years go by, the more data we're going to have. That's why you got to subscribe to this channel. Keep watching, because I'm going to be looking at these total returns every month, guys. That's what I do on my best cover call ETF series now, which I renamed, going on, I think, going on 5 years here, right? Looking for tax efficiency, withdrawal model, factoring in distributions, map strategy. Can you recommend an analysis for that? Look, I did a plan for my parents. That's my plan. I'm not a tax expert or accountant expert. What they will probably tell you is, you can make an appointment with Adam from Parallel Wealth. I'll charge you a bunch of money and he'll give you a plan. But again, this is what I'm doing for my parents, and I think it's a good plan. Maybe you agree with me, maybe you don't. I don't really care. That's what we're doing, so that would be my opinion. Hi, Adrian. Love your site. How can I set up my cash account with QTrader to beneficiary only, not estate? I have no idea what that means. Have you ever thought about getting Panama citizenship? So Panama citizenship, you could get it, I think, after 5 years that you're a resident. And again, it will not impact investments. Guys, in Panama, there's no tax on foreign income. Okay? If you get the citizenship, I don't think really gives you anything besides a Panamanian passport. But I think you might have to take a Spanish test. But it's almost like an accolade. I have my full residency. That's really all you need. Hi, Adrian. Before you got into these awesome covered calls, did you ever invest, trade, swing trade, or day trade individual stocks? I kind of used to be swing trade for quite a few years, but we're talking like 2011, 2017, 2018. That's, when the time, 2017, 18 is when my mortgage was paid off. So when I became a serious investor and I was trying to figure out what to do. But before that, I was pretty much doing swing trading, just buying random things for fun that I thought were down and trying to sell them later on. So bad idea. I wish I would have just started as an investor. Once you have your total shares added together, how do you get your book cost? I use this tool here called the online-calculator.org/stock average calculator. So this is what I use. You just put your number of shares, purchase prices, you hit yes, and it'll give you total number of shares and total amount. So whenever I add anything, I keep using this every month to get the accurate. I don't trust my broker because the broker will reduce it with the ROC, and I don't want that. I want pre-ROC ACB, average cost base. So this is the tool I use. So yeah, I do it manually with that tool. Oh man, how many questions left we have? We're getting there. Dinner soon over here. When swapping similar ETFs, how can we make sure we're not just chasing past performances? I don't understand that. When swapping similar, how can we make sure we're not just chasing past? Just look at the total returns. That's the best thing you could do. Make sure you're comfortable with the stocks you're investing in, the strategy of ETF. And if you know the strategy, the cover cost strategy, if you know the stocks, you'll know more or less what it's going to perform similar to. But you only get the real performance data after a year. You do the total return comparisons. How important is reinvesting the distributions in your strategy? If you need X month in cash flow, should you target 1x, 2x, or 3x that amount in monthly distributions? Very interesting question. I kind of get this question quite a bit. This is all about distribution management. This is all case by case. You got to make your own decisions here. My golden rule is you spend what you need, you pay your bills, and you reinvest the rest. That's what I do. If you need X amount per month and your portfolio is making that amount, if you need 10,000 and you have a portfolio that's making you 10,000, you better make sure that the funds that you've selected, and it's always a good idea to reinvest more. Okay, if your portfolio is making 10,000 and your expenses are 10,000 a month, you're living pay to paycheck off your portfolio. Is living pay to pay a good idea? Not really. You should always have a little bit to reinvest. That's always a good idea. Whether it's 10%, 20%, 30%, that's really up to you. It's up to you to manage those distributions. Right. And if you're really tight and you're really fixed, make sure you're investing in things that you know are probably not going to reduce distributions. You're not going to go and MSTE, for example, right? A single stock stuff. You're going to go in more things like the 4 Horsemen or the 4 Defensemen of PII, right? So this question, I kind of get an iteration of it a lot. It's a bit hard to answer. The best answer I could give you is, trust me, you'll figure it out with time and experience. But make sure you set yourself up according to how old you are and what you're expecting. Right? Is Panama where you plan to stay for good? Yeah, of course. I don't understand. I don't know why I would ever leave. I mean, we have a beach place. We have a city place now. The city place where we're living in a 5-star hotel. It's beautiful. The Trump Tower. It's amazing. It's the best place I ever lived at in my life. I don't think I'll ever. Do you think you will ever move back to Canada again full time? No way. Why? Why would I ever do that? I live in Montreal, 49 years old, want to retire in 5 years. I still work, making approximately 100K. I have my TFSA and RRSP optimized. I'm in the process of building my investment portfolio in a non-registered account. Of course, no choice, right? If everything is full. Which ETFs would you recommend having in a non-registered to avoid paying too much tax? So that's a good question. So HYLD, QQCL, HHIS, BIGY, HDIV, ECHI, CDAY, the taxes are going to be tax consequences are going to be very similar with all these funds. Most of the income is capital gains and ROC. So again, guys, I have a playlist that's called taxes. You could look at this. Oops.
Hey everyone, welcome back to the channel, your number one source.
Playlist. Taxes, where I talk about tax stuff. But if you're in a high tax bracket, your TFSA and RRSP is full, you might be better off going with a growth-oriented, not a covered call ETF if you're in a high bracket, right? Because you're going to be paying the taxes on HYLD, QQCL, HHIS, BIGY, whether you reinvestment or not. The good news is that it's all capital gains and ROC, right? So it's better than regular income, that's for sure. And ROC is deferred capital gains. So yeah, these are all, again, look at my tax videos, because trying to say which one's better, QQCL, HDIV, it depends on your province and tax bracket. Depends on your province and tax bracket. If something is more Canadian oriented, like HDIV and ECHI, it's going to have some Canadian eligible dividends, which is great in low tax brackets, but not as great in capital gains, is better in higher tax brackets. So look at my tax videos, but if you're going to retire in 5 years, maybe a good option would be something like a leveraged S&P 500, like USSL from Global X, or HEQL, which is, like XEQT and VEQT, then Global X has HEQT. Well, HEQL is a leveraged version. So you'll get growth, but it only has 1% yield. So you could sell that and then convert it to more higher income oriented when you're in a lower tax bracket. So that's another plan you could do for the non-registered specifically. And guys, let me remind you, these types of questions, some of them are very personal. I'm trying my best here, but this is why I offer the one-on-one coaching sessions. You could ask me, we could discuss anything you want in that 1 hour. I could educate you based on your question. And when it comes to taxes and tax brackets and all that stuff, I've mastered it in Canada, not in the US, but I've mastered it in Canada. So you could always book a session with me and we could discuss that kind of stuff. My mother has 100K and looking to invest. It will be in a non-registered. She doesn't need the money. What should she invest it in? I don't know. I don't know who you are, what your situation is, what your volatility tolerance is. You need to book a session with me if you want further help on that. It's very hard for me to answer. I have no idea of anything about you. Do you know of any funds that use leverage and only write cover calls options on the leverage portion? Yes, the Daymax series from Hamilton do that. SDAY, QDAY, and CDAY. They only write the cover calls on the 20% of the portfolio, the 0 DTE calls. And another one is CBNK from Mulvihill, where it's the 6 banks, 25% leverage. They only write the calls on the 25% leverage. So strategy to beat the underlying. CBNK is doing okay, but bank is beating it. So you would think that strategy would be genius, but it looks like it's pretty good. But we're curious to see on how the Daymax series pan out when a year of data has been out. Besides family and friends, what, if anything, do you miss about Montreal? Nothing. I don't miss the French. I don't miss the taxes. I don't miss the weather. I don't miss the medical system. I don't miss, why would I ever miss that? All right, I miss the bagels, okay? Once in a while, I get a craving for a good Montreal bagel. And I do miss the old bar I used to go to, which have like the best sandwiches. But you could find anything you want in Panama City. But that's pretty much it. I have ENCL and Utes, was thinking of adding back GDV or PWI or both, or go with an all-in-one, as I am not really taken back by split shares, but like a little protection. And I miss not having a little Brompton products in the mix. Thoughts. My thoughts are the Class A ETF from Brompton is their best product. Still your biggest fan, of course. Thank you, David. Much appreciated. My question is around all the cover call ETFs, NAV option calls, blah, blah, blah. What does that mean? I don't know. All the CC ETFs, NAV option calls. NAV option calls. Touch base on this if you have anything new to add. I don't know what that means. What date and time of the event? So yeah, you'll get more news on that. Retirement, it's us. I got a lot of people responding to the poll, so more on that. But if you're a member, look, I love the PII Inner Circle members. You guys will always have top priority for anything. So the first one, we're still planning it. We're still not sure. But the Inner Circle members, you'll be the first to know. Okay, and the first ones to be able to buy tickets. Trust me, we'll see how successful it is. Now, this is going to be like legit. We're booking a hall, we're booking the food, we're booking the audio, video, and panels, but we want to make it a little bit more intimate. We don't want to make it like a marketing Blossom event. We're actually trying to plan it hopefully at the same time as the Blossom event in Toronto. So, and I'm still talking to the Harvest and Hamilton and Global X to help us out with the cost, because it could be upwards of like $50,000. So you'll be the first to know. Does the 2026 outlook still appear to support precious metals versus S&P 500 and NASDAQ? And listen, I don't know. I don't care. Oh, he says it. Or you don't care. I don't care. I don't care about next 6 months, 2026. I don't care about trends and rotations and in and out, risk on, risk off. I'm going to invest what I think is going to perform well in my convictions for the long term. Dogs or cats? Oh wait, cats. Smart choice. I like both, but cats are just special to me. Can you tell me why HHIC pays 18 cents and HHIS pays 27 cents? Well, the Canadian stocks are less volatile. They generate less premium, so of course the yield is going to be lower. That's why CANY has less yield than BIGY, right? So that's really why. Oh, wait, the same holdings. I think you're talking about HHIS and HHIH. HHIH is a non-leveraged version of HHIS. So the yield is going to be lower. Yeah, okay, somebody already answered for me. Bonjour, est-ce qu'on peut vous écrire en français? Yeah, but I prefer English. I said oui, but somebody just wrote LOL and this person just didn't write their question. Véronique. So yes, you could, but I'll just translate it to English and answer it in English. Last question. Woohoo! I'm getting hungry now. I was wondering your thoughts about withdrawing an RRSP as a 38-year-old Canadian resident. I thought about either just withdrawing dividends to TFSA for HHIS.U and HYLD.U or liquidate the entire RRSP to try to increase my TFSA income and increase my available to withdraw out margin. Listen, Chris Wong, it's not a good idea to withdraw from the RRSP if you're working and you're in a high tax bracket. It's really designed not to, right? To supplement your income later and start withdrawing when you're in a lower tax bracket. Exactly. I'm also concerned about an expensive tax bill. So Chris Wong, leave your RRSP as it is. Let it keep compounding and dripping. I know it seems like you're anxious to max out your TFSA, but you could do it. Trust me, find the money. You could do it. Okay. Max out your TFSA and do the RRSP in parallel. I'm wondering to achieve financial freedom faster. Yes, the TFSA is a great tool, but the RRSP is also so. Yeah, I'm not going to need my RRSP. So Chris, look, it's a lot of loaded questions. Book a session with me. We could go over. I get a better understanding because you're a bit all over the place. But trust me, the RRSP is not designed to take out right now. Because you're going to pay taxes and penalties. It's going to count as regular income, especially if you're in a high tax bracket right now. So guys, this was fun. I think I did at least 50 questions. So I really appreciate you guys being Inner Circle member, guys. You'll always have my top priority, my love and my affection. I will always be there for you. Really appreciate it. And I know this video is public, but the next time I do this post and I get probably another million questions, the video is going to be for members only. So if you're interested in becoming a PII Inner Circle member, trust me, you don't regret it. And by the way, you could try it out for a few months. It's only $2.99. There's 2 levels. Click the little join button. There's the whole video on the whole program and what you get. Please watch it. All the explanations are there. A lot of personal questions, guys. Don't forget that I offer one-on-one coaching sessions. I know my website is ugly. We're working on it. But right here, passiveincomeinvesting.ca, click on this link. It's called the Click Here for Info. I explain how to book a session. And if you're a PII Inner Circle Plus member, a second level, you get $75 off. If you're not interested in that, you could click here and you get sent to the calendar. If there's any spots, you could book a session. You have me for the whole hour. You could ask me whatever you want. Okay, so just don't forget about that. Really appreciate it again, you being an Inner Circle member, guys. Take care, stay safe, stay passive, stay honorable, and see you next time.